Semiconductors are still the main character of this entire stock market. And this might be the last act of the party. Those two sentences shouldn't both be true at the same time, but they are, and by the end of this video you're going to understand exactly why, because there's a financial structure sitting underneath the AI data center boom that most retail investors have never even heard of. It has a name. It's called an SPV, and it changes how you should be thinking about every semiconductor stock you own. Here's where I land. This isn't a bubble that's about to pop tomorrow, and it isn't a crash call. What I actually think is happening is narrower and more useful than that. Near term, these stocks are heading into a box range, not a straight lineup. Profit growth is decelerating, not collapsing. And underneath the Industrial Revolution narrative, there's a financial engineering story that behaves a lot more like a leveraged real estate deal than a factory expansion. Stick with me, because that distinction is the whole video. My name is Moon. I spend an unreasonable amount of time tracking where institutional money actually moves, not the headline, the mechanism underneath it. If you've ever owned a semiconductor stock and felt like you didn't fully understand why it was up 20% in a week or why it suddenly stalled, this video is for you. If this changes how you look at your own portfolio, hit subscribe and drop a like. It genuinely helps this channel keep making videos like this. Here's the myth almost everyone believes right now. AI data centers are an industrial revolution. Revolutions don't stop for pullbacks. Just hold and don't overthink it. Okay, but here's the thing. An industrial revolution is built with retained earnings and equity. What's actually financing a huge chunk of this AI buildout is something closer to a leveraged real estate project. And once you see that, you can't unsee it. Let's follow the money, and I mean actually follow it, not just the top-line CapEx number. Hyperscalers, the Microsofts, Metas, Amazons of the world, are increasingly funding data center buildouts through special purpose vehicles, or SPVs. These are separate legal entities set up specifically to hold the debt and the risk, so it doesn't sit directly on the parent company's balance sheet. Here's the analogy. It's the same basic playbook as real estate project financing. A developer sets up a separate entity to build one tower. So if that one tower goes bad, it doesn't take down the whole company. Sounds smart. It also means the information around that specific project gets murkier, the cost of capital creeps up because lenders are pricing in that opacity, and if permits get pulled or a project gets delayed, the shock doesn't stay contained to one building. It can ripple through the financing structures around it. And here's why this should sound familiar, especially if you've watched what happened with USA's own real estate project financing market a few years back. A single stalled project doesn't just hurt that project's lenders. It makes every other lender in similar deals nervous at the same time. So they all reprice risk together, and credit gets more expensive across the board, even for projects that were never actually in trouble. That's not a data center problem. That's a leverage problem wearing an AI costume. And the leverage here is real. When a data center project is financed mostly through SPV debt rather than the parent company's own cash, a relatively small delay in revenue, say a data center that goes live 6 months late, can turn into a much larger equity loss for whoever's holding the thin slice of capital underneath all that borrowed money. That's just how leverage works. It magnifies good outcomes, and it magnifies bad ones. And right now, a lot of the AI build-out is running on exactly that kind of magnification. That's not a hypothetical. Analysts have flagged that if permitting cancellations or construction delays hit even one or two of these projects, it can shake confidence across the entire financing chain because SPV lenders start repricing risk everywhere at once, not just at the one project that had the problem. Now here's where it gets interesting, because the market is already quietly pricing this in. You just have to know where to look. Profit growth at the major chip makers hasn't collapsed, but it has entered a deceleration phase. The rate of profit growth is slowing down, even while absolute profits stay high. And here's the part that trips people up. Stock prices tend to front-run that deceleration. The chart usually stalls out before the earnings report confirms it, not after. That's exactly why the near-term expectation here is a box range, stocks chopping between a ceiling and a floor, rather than another leg straight up, not a crash, not euphoria. A pause where the market digests whether the next growth chapter is actually there. This is the part most retail investors get backwards. They wait for the headline earnings miss to sell, when the stock already told them 3 months earlier that something was shifting. This is the part that actually keeps me up more than the SPV structure does. China is not sitting still. Even with export restrictions and a technology gap, Chinese semiconductor players are working to close that gap, and you cannot fully rule out them catching up over a longer time horizon. And here's what people don't fully price in. It's not just about who has the most advanced chip. It's about the cost curve. China's memory makers have been ramping legacy DRAM and at 90 capacity aggressively, and even if they're a generation or two behind on the most advanced nodes, flooding the lower end of the market with cheaper supply puts pressure on average selling prices across the entire industry, not just the segment they're competing in directly. That's the quiet mechanism. You don't need to beat Samsung and SK Hynix at the cutting edge to hurt their margins. You just need to make the commodity end of the business less profitable. If that happens, it changes the entire cost competition calculus for a multi-year CapEx cycle that assumes Western and Korean chipmakers keep their technological lead. Combine that with the SPV fragility from before, and you get a specific nameable risk. Now, not the market might go down, but what happens to capital costs across this entire financing web if one major project stumbles at the same time competitive pressure from China intensifies? That's the scenario worth actually watching, not vague bubble talk. Here's where this becomes something you can use instead of just something you know. First, the value principle. Value is something you determine, not something the crowd determines for you. The best entries in this space have historically come not when everyone's celebrating, but when people are scared enough to run for the exits. That's not a cute quote. It's an operating rule. Second, the barbell strategy. Semiconductors are the market's lead sector right now, so cutting them out entirely isn't realistic and probably isn't smart. But going all in on one sector at the top of a euphoria cycle is exactly how people get hurt in the BoxRange phase. Think of it literally as a barbell, my weight concentrated on both ends, almost nothing in the flimsy middle. On one end, you keep a real, meaningful core position in the sector, actually driving this market because you don't want to sit out the trend entirely. On the other end, you hold something genuinely uncorrelated: cash, short-duration bonds, defensive names that don't move on the same AI CapEx headlines. What you avoid is the mushy middle, a portfolio that's moderately exposed to everything AI adjacent, which sounds diversified, but actually just means you're fully exposed to the same single risk factor wearing different tickers. Inside that semiconductor sleeve, use the BoxRange volatility instead of fighting it. In a range-bound market, buying strength and chasing breakouts is a worse strategy than scaling in near the range floor and trimming near the range ceiling. And build yourself an actual risk dashboard, not vague headlines, but specific triggers. SPV credit spread news, permitting or construction delay stories, and hyperscaler CapEx guidance every earnings season. Those 3 data points will tell you where this cycle actually stands months before the stock price fully reflects it. Now, third, and this might be the most important one, invest at your own pace. Watching someone else's timeline and trying to match their speed is one of the most common ways people blow up a good long-term thesis. Your entries, your position size, your holding period, that has to come from your own plan, not from what's trending in your feed this week. Now, I know what you're thinking. Moon, if semiconductors are still the market leader, shouldn't I just be aggressive and ride it? Fair pushback. But here's my honest answer. Being the market's main character and being late in this specific cycle's euphoria phase are not contradictory. They're actually the exact combination that produces the most dangerous kind of investor mistake. People see sectors still leading and translate that into still safe to chase, when what it actually means is still the right sector, wrong entry discipline. The thesis on semiconductors long-term isn't broken. The near-term entry behavior most people are using right now is, look, I'm not telling you to sell your semiconductor stocks, and I'm not telling you to panic about an SPV structure most people have never heard of until today. I'm telling you to know what you actually own, know what's financing the boom underneath it, and buy your positions on your terms, not on the market's adrenaline. Protect and grow what you've built. Subscribe if this was useful. I'll see you in the next one.